After the financial sector reform, the Indian financial sector has undergone significant changes. The deregulation of lending rates, free pricing of equity issues, entry of private sector institutional investors, including financial institutional investors, opening up of the banking sector to private sector, allowing Indian companies to directly tap. After the financial sector reform, the Indian financial sector has undergone significant changes. The deregulation of lending rates, free pricing of equity issues, entry of private sector institutional investors, including financial institutional investors, opening up of the banking sector to private sector, allowing Indian companies to directly tap the foreign capital markets and so on, are some of the major reforms which have changed the scenario of the Indian financial system. This new freedom has increased competition in the Indian corporate sector. The capital market is an important source of meeting the growing long-term financial requirements of corporates both in private and public sectors. On one hand, due to the colossal fund requirements of both corporates and financial institutions, the competition has become intense among the various classes of issuers to corner a share of the investors' funds, and on the other hand, the investors are proving to be increasingly savvy. Hence, to cater to the different requirements of both issuers and investors, it has become essential for issuers to innovate and design new financial instruments. After studying this module, you shall be able to understand the meaning of new financial instruments, know the reasons for innovations in financial instruments. Number 3, identify and develop an understanding of the various financial instruments introduced recently, such as the floating rate bonds, the zero interest bonds, the deep discount bonds, municipal bonds, perpetual bonds, inverse float bonds, collateralized debt obligations, securitized papers, fully convertible bonds, non-convertible debentures, etc. We shall now study about the financial instruments. Meaning of financial instruments. The definition of a financial instrument is broad and is considered to be any contract that gives rise to a financial asset of one entity and a financial liability of equity instrument of another entity. A financial instrument is a tradable asset of any kind, either cash, evidence of an ownership interest in any entity, or a contractual right to receive or deliver cash or another financial instrument. Examples of financial instruments include trade receivables and payables, bank loans and overdrafts, issued debt, investments in ordinary and preference shares, investments in securities such as shares and bonds, and various derivatives. Classification of financial instruments. In today's financial marketplace, financial instruments can be classified generally as equity based, representing ownership of the asset, or debt based, representing a loan made by an investor to the owner of the asset. Foreign exchange instruments comprise a third unique type of instrument. Different subcategories of each instrument type also exist. Financial instruments can also be categorized by form depending on whether they are cash instruments or derivative instruments. Number 1. Cash instruments are financial instruments whose value is determined directly by the markets. They can be divided into securities, which are readily transferable, and other cash instruments such as loans and deposits, where both borrower and lender have to agree on a transfer. Number 2, derivative instruments are financial instruments which derive their value from the value and characteristics of one or more underlying entities, such as an asset, index, or interest rate. They can be divided into exchange traded derivatives and over the counter derivatives. Reasons for innovations in financial instruments. Number 1. Every product needs constant re-engineering. Moreover, it has to be tailored according to the needs of the consumers. The investment environment does not get a boost if there are repeated offerings of the same product. Hence, new designs of financial products are always needed. 2. The interest rates had declined, and this trend forced the corporate world to think of new financial instruments. 3. Investors also prefer not to be saddled with long-term instruments. Hence, the instruments with varying maturity periods and with various put and call options are preferred. 4. The old trend of getting finance from financial institutions has changed. Now companies prefer the capital market as a source of finance. To successfully tap the capital markets, companies are compelled to offer attractive terms even on debt securities in order to raise funds. 5. Investors have shied away from the equity market in the last few years due to various capital market scams. Attractive financial instruments are needed to lure these investors back. We shall now throw some light on various types of new financial instruments. In order to improve the attractiveness of bonds, debentures, some new features are added. As a result, a wide range of innovative debt instruments have emerged in India in recent years. Some of the important ones among these are discussed below. Floating rate bonds, popularly known as FRBs. Floating rate bonds are also known as floating rate notes, are bonds that have a variable coupon equal to a money market reference rate. The interest rate on these bonds is not fixed and is linked to a benchmark rate or anchor rate. Almost all FRBs have quarterly coupons, that is, they pay out interest every 3 months. FRBs carry little interest rate risk. An FRB has a duration close to 0 and its price shows very low sensitivity to changes in the market rates. When market rates rise, the expected coupons of the FRB increase in line with the increase in forward rates, which means its price remains constant. Thus, FRBs differ from fixed rate bonds whose prices decline when market rate declines. As FRBs are almost immune to interest rate risk, they are considered conservative investments for investors who believe market rates will increase. The risk that remains is credit risk. In India, it is concept which has been introduced primarily to take care of falling markets or to provide a cushion in times of falling interest rates in the economy. It helps the issuer to hedge the loss arising due to interest rate fluctuations. The State Bank of India was the first bank to introduce bonds with floating rates for retail investors. The SBI floating rate bonds were linked to the bank's term deposit rates, which served as an anchor rate. The treasury bill rate can also be the anchor rate. The interest rate is linked to the anchor rate as it reflects the economic indicators. The NSE MIBOR is used as an anchor rate for floating rate bonds. To make these bonds attractive to investors, the interest rate always has a fixed markup price over the above anchor rate. In case of IDBI bond issues, the fixed markup was 2% and the anchor rate was 364 days treasury bill rate. FRBs ensure that neither the borrower nor the lender suffer due to volatile interest rates. If the interest rate rises, the lender benefits as he earns a higher interest, and if the interest rate falls, it is advantageous to the borrower as he can raise funds at low cost. Borrower companies issue FRBs with a cap or a floor. The cap is the maximum interest that the issuer can pay, while the floor is the minimum interest that a subscriber earns, leading to an advantage both to the issuer and the subscriber. FRBs serve as diversifying instruments in debt management as they take advantage of the term premium while minimizing the refinancing risk. However, FRBs are vulnerable to interest rate risk. FRB is an innovative instrument in falling interest rate regime, but it requires an active secondary debt market. Zero interest bonds. Zero interest bonds are also known as zero coupon bond. It is a bond brought at a price lower than its face value, with the face value repaid at the time of maturity. It does not make periodic interest payments. When the bond reaches maturity, its investor receives its par or face value. These bonds benefit both the issuers and the investors by limiting funds cost when interest rates are volatile for the issuer and by reducing the reinvestment risk for the investor. Zero interest bonds are sometimes convertible into equity on maturity, which entails no outflow for the issuers, or into regular interest bearing bond after a particular period of time. Zero interest bonds may be long or short term investments. Long term zero coupon maturity dates typically start at 10 to 15 years. The bonds can be held until maturity or sold on secondary bond markets. Short-term zero coupon bonds generally have maturities of less than 1 year and are called bills. Zero interest bonds have duration equal to the bond's time to maturity, which makes them sensitive to any changes in the interest rates. Investment banks or dealers may separate coupons from the principal of coupon bonds, which is known as the residue, so that different investors may receive the principal and each of the coupon payments. This creates a supply of new zero coupon bonds. Companies such as Mahindra and Mahindra, HB Leasing and Finance have been pioneers in introducing these bonds in Indian market. These bonds are the best options for individuals and institutions who look for safe and good returns and ready to hold bonds till maturity. Moreover, these bonds do not carry any interest which is otherwise taxable. These bonds are attractive for issuers, companies with projects having a long-term gestation period, as there is no immediate interest commitment, and on maturity the bonds can be converted into equity shares or non-convertible debentures depending on the capital structure requirements of the company. Deep discount bonds. popularly known as DDBs. A deep discount bond is a zero coupon bond whose maturity is very high and is offered at a discount to the face value. Maturity period of these bonds are more than 15 years. The Industrial Development Bank of India (IDBI) was the first financial institution to have offered deep discount bonds in the year 1992. The issuers have successfully marketed these bonds by luring the investors to become a Lakhpati in 25 years. Moreover, these instruments are embedded with call and put options, providing an early redemption facility both to the issuer and the investor at a predetermined price and date. The issuer becomes free from intermittent cash flow problems, and the funds can be deployed in infrastructure projects which involve long-term periods. Municipal bonds. Municipal bonds are securities that are issued by municipal corporation of the city for the purpose of financing the infrastructure needs of the issuing municipality. These needs vary greatly, can include schools, streets and highways, bridges, hospitals, public housing, sewer, water systems, power utilities, and various public projects. These bonds were made scalable through government guarantee. The issue of a municipal bond receives a cash payment at the time of issuance in exchange for a promise to repay the investor who provides the cash payment, the bondholder over a time. Repayment periods can be as short as few months, although this is rare, to 20, 30 or 40 years or even longer. Municipal bondholders may purchase bonds either directly from the issuer at the time of issuance, that is from primary market, or from the bondholders at some time after issuance on the secondary market. In exchange for an upfront investment of capital, the bondholder receives payments over time composed of interest on the invested principal and a return of the invested principal itself. Repayment schedules differ with the type of bonds issued. Municipal bonds typically pay interest semi-annually. Shorter term bonds generally pay interest only until maturity. Longer term bonds generally are amortized through annual principal payments. The Indian municipalities need a huge sum to finance a number of basic projects, and the financial health of municipalities is in a poor state. To cope up with the financial requirements, new type of debt security was introduced by the government in the form of municipal bonds. The Ahmedabad Municipal Corporation was the first urban local body to raise funds through municipal bonds. It was the first urban local body to receive a general obligation rating for its municipal bonds in February 1996 and raise funds through municipal bonds without a state government guarantee. The Bangalore Mahanagar Palika was the first to issue municipal bonds for rupees 125 crores with 7-year maturity and a coupon of 13% annum in December 1997. Perpetual bonds. Perpetual bond, which is also known as a perpetual or just a perp, is a bond with no maturity date. Therefore, it may be treated as equity, not a debt. Issuers pay coupons on perpetual bonds forever, and they do not have to redeem the principal. Perpetual bond cash flows are therefore those of a perpetuity. Inverse float bonds. Inverse float bonds are bonds carrying a floating rate of interest that is inversely related to short-term interest rates. The floating rate could be the MIBOR, Mumbai Interbank Offer Rate. If the MIBOR falls, the return for the investor raises and vice versa. The actual rate payable on these bonds is arrived at by subtracting the floating rate from a fixed benchmark rate. Suppose the fixed benchmark rate is 12% and the 6-month MIBOR is 7%, then the interest rate payable on these bonds is 5%, that is 12% minus 7%. These bonds enable investors to earn high returns in a low interest rate environment. As interest rates are highly volatile, the investor has to observe the interest rate behavior carefully over the entire bond period, else he could end up getting a poor return. Thus, both the investor and the issuer have to hedge the interest rate risk. If the interest rates go up, the issuer benefits as the coupon rate of his bonds will decline in spite of higher interest rates. Inverse float bonds are the latest entrants in the Indian capital market. The Aditya Birla Group, the Grasim, and the Hindalco issued inverse float bonds in August 2002. In Cholamandalam Investment and Finance Company Limited were the first non-banking finance company to raise funds through the issue of inverse floaters. Collateral debt obligations, CDO. Collateralized debt obligation is securitization of corporate obligations such as corporate loans, corporate bonds, and assets-backed securities. Collectively, collateralized debt obligations consists of collateralized bond obligations, loan obligations, and credit-linked notes and made from the same financial family. Banks and financial institutions use this instrument to meet regulatory obligations and to increase their revenues. Under the Basel Accord formulated in the year 1988 by the Basel Committee on Banking and Supervision, banks in most of the developed countries are required to maintain a risk-based capital of 8% of the outstanding balance of commercial loans. These high risk-based capital requirements make the holding of commercial loans unattractive as the margins on these loans are also low. By securitizing loan portfolios, banks are not in a position to trim their balance sheets, but they are able to generate funds from these portfolios. These structures of a CDO consist of multiple layers called tranches, which are formed by pooling underlying assets. Each tranche will have a pool of assets from corporate loans and bonds of similar seniority and maturity. These tranches are then rated by credit rating agencies and marketed. The ICICI Bank's first CDO issue failed to take off in March 2002 and recalled because of unfavorable market conditions and lack of regulatory guidelines. In February 2004, the bank altered the product structure by bringing down the average maturity of the issue to around 2 years. The rupees 100 crore CDO issue was mopped up by institutional investors. The ICICI Bank sold corporate loans given to 15 borrowers of varying size across 11 industries through this issue to raise new assets as well as enhance exposure management in terms of specific sectors. CDOs are new in Indian market and new product takes time to gain market acceptance. However, with an increase in investor awareness and setting up of a regulatory framework, this instrument will be preferred by Indian banks and financial institutions in times to come. Securitized papers. Securitization is a process by which a company raises money by selling off its receivables. These receivables are sold off to cash-rich investors by converting them into securities. The receivables are sold at a discount to the investors, which represent the yield. It is a process through which liquid assets are packaged and converted into tradable securities known as pass-through certificates, PTCs. These securities are also referred to as asset-backed securities. If the instrument securitized is a housing loan, the resultant instrument is referred to as mortgage-backed securities, that is MBS. In securitization, the assets to be securitized are identified on the basis of their creditworthiness. Then the security is rated by a specialized credit rating agency. The pool is sold to a special purpose vehicle which acts as a trustee. The SPV is the entity that owns the assets once they are securitized. The assets are held by the SPV to ensure that the investor's interest is secure even if the originators goes bankrupt. The SPV issues the asset-backed security, and the task of collecting the interest due on underlying asset is left either to the seller or to a third party. The securities can be listed on the NSE. As the securities are negotiable instruments and listed, they can be traded in the secondary market as well. Since the securities are assets for the seller, the process is called as asset securitization. However, once it is listed on a stock exchange, it becomes a debt product for the investor, and hence the process is called debt securitization. The securitization and reconstruction of financial assets and enforcement of Security Act 2002, the Government of India in June 2002 introduced this act to regulate securitization and reconstruction of financial assets and enforcement of security interest. The act provides the first legal framework that recognizes securitization, asset recovery and reconstruction. To create a market in securitized debt, the government has floated a company called the Asset Reconstruction Company India Limited, wherein the government holds 49% stake, ICICI a 24.5% stake, and rest is held by financial institutions. For securitization to grow at a rapid pace, there is a need to increase the investor base by persuading public sector banks, provident funds, trusts and foreign institutional investors to invest in this market. Develop standard procedures and accounting standards, introduce change in tax laws and develop an active secondary market. The dealing in the securitized instrument needs to be transparent. A formal regulatory framework for securitization is needed. Fully convertible bonds, FCDs. A type of debt security where the whole value of debenture is convertible into equity shares at the issuer's notice. The ratio of conversion is decided by the issuer when the debenture is issued. Upon conversion, the investor enjoys the same status as ordinary shareholders of the company. The main difference between FCDs and other convertible debentures is that the company can force conversion into equity, whereas in other types of convertible securities, the owner of the debenture may have that option. The FCDs also differ from partially convertible debentures. In case of PCDs, part of the instrument is redeemed and part of it is converted into equity. Non-convertible debentures, NCDs. Non-convertible debentures means a debt instrument issued by a corporate with original or initial maturity up to 1 year and issued by way of private placement. A corporate shall be eligible to issue NCDs if it fulfills the following criteria, namely, number 1, the corporate has a tangible net worth of not less than rupees 4 crores as per the latest audited balance sheet. 2. The corporate has been sanctioned working capital limit or term loan by banks or all India financial institutions. And lastly, the borrowed account of the corporate is classified as standard asset by the financial bank or institution. An eligible corporate intending to issue NCD shall obtain credit rating for issuance of the NCD from one of the rating agency, that is, the Credit Rating Information Services of India Limited, CRISIL, or the Investment Information and Credit Rating Agency of India, ICRA, or the Credit Analysis and Research Limited, CARE, or FITCH Rating India Private Limited, or such other agencies registered with Securities and Exchange Board of India, that is SEBI, or such other credit rating agencies as may be specified by the Reserve Bank of India from time to time. NCDs shall not be issued for maturities of less than 90 days from the date of issue. The exercise date of option put and call, if any, attached to the NCDs shall not fall within the period of 90 days from the date of issue. The tenor of the NCD shall not exceed the validity period of the credit rating of the instrument. Procedure of issuing NCDs. The corporate shall disclose to the prospective investors its financial position as per the standard market practice. The auditors of the corporate shall certify to the investors that all the eligibility conditions set forth in these directions for the issue of NCDs are met by the corporate. The requirements of all the provisions of the Companies Act 1956 and the Securities and Exchange Board of India, Regulations 2008, or any other law that may be applicable shall be complied with by the corporate. The debenture certificate shall be issued within the period prescribed in the Companies Act 1956 or any other law as in force at the time of issuance. NCDs may be issued at face value carrying a coupon rate or at a discount to face value as zero coupon interest as determined by the corporate. We shall now recapitulate what we have learned so far. A financial instrument is a tradable asset of any kind, either cash, evidence of an ownership interest in an entity, or a contractual right to receive or deliver cash or other financial instrument. Examples of financial instruments include trade receivables, payables, bank loans and overdrafts, issued debt, investments in ordinary and preference shares, investments in securities such as shares and bonds, and various derivatives. In today's financial marketplace, financial instruments can be classified generally as equity based, representing ownership of the asset, or debt based, representing a loan made by an investor to the owner of the asset. Foreign exchange instruments comprise a third unique type of instrument. Floating rate bonds, also known as floating rate notes, are bonds that have variable coupons equal to a money market reference rate. The interest rate on these bonds is not fixed and is linked to a benchmark rate or anchor rate. Almost all FRBs have quarterly coupons, that is, they pay out interest every 3 months. Zero interest bonds, also known as zero coupon bond, is a bond bought at a price lower than its face value, with the face value repaid at the time of maturity. It does not make periodic interest payments. When the bond reaches maturity, its investor receives its par or face value. A deep discount bond is a zero coupon bond whose maturity is very high and is offered at a discount to the face value. Maturity period of these bonds are more than 15 years. Municipal bonds are securities that are issued by municipal corporation of the city for the purpose of financing the infrastructure needs of the issuing municipality. These needs vary greatly but can include schools, streets and highways, bridges, hospitals, public housing, sewers, water systems, power utilities, and various public projects. These bonds were made saleable through government guarantee. Perpetual bond is a bond with no maturity date. It may be treated as equity, not as debt. Issuers pay coupons on perpetual bonds forever, and they do not have to redeem the principal. Inverse float bonds are bonds carrying a floating rate of interest that is inversely related to short-term interest rates. The floating rate could be MIBOR, that is Mumbai Interbank Offer Rate. If the MIBOR fails, the rate of investors rises and vice versa. Collateralized debt obligations is securitization of corporate obligations such as corporate loans, corporate bonds, and asset-backed securities. Collectively, centralized debt obligations consist of collateralized bonds obligations, collateralized loan obligations, and credit-linked notes that emanate from the same financial family. Banks and financial institutions use this instrument to meet regulatory obligations and to increase their revenues. It is a process through which liquid assets are packaged and converted into tradable securities known as pass-through certificates, that are PTCs. These securities are also referred to as asset-based securities, that is ABS. If the instrument securitized is a housing loan, the resultant instrument is referred to as mortgage-backed securities, MBS. The securitization and reconstruction of financial assets and Enforcement of Security Interest Act was introduced by the Government of India in June 2002 to regulate securitization and reconstruction of financial assets and enforcement of security interest. The Act provides the first legal framework that recognizes securitization, asset recovery and reconstruction. Fully convertible bonds is a type of debt security where the whole value of the debenture is convertible into equity shares at the issuer's notice. The ratio of conversion is decided by the issuer when the debenture is issued. Upon conversion, the investors enjoy the same status as ordinary shareholders do in a company. Non-convertible debentures mean a debt instrument issued by a corporate, including NBFCs, with original or initial maturity up to 1 year and issued by way of private placement.